Okay, let's take another look at what's happening in North American trading as we kick off the Thursday session. And there's a lot to think about right now. You got obviously different views on interest rates from here. I know our Canadian stock market is a little weaker this morning. It is interesting to note this continued record story in the United States. It invites the question of, regardless of what you think's happening with rates or the economy, can you fight the tape? Should you fight the momentum of the markets? Let's ask Chhad Aul. He's Chief Investment Officer and Head of Multi-Asset Solutions at Sun Life's SLGI Asset Management. Good to see you.
Great to be here.
Let's just jump right into it.
Sure.
We talk enough about the Fed and the Bank of Canada and all that kind of stuff. I think a lot of people just want to know, how should they be allocated in the market right now? Fighting momentum, is it a losing battle?
I mean, at some point, momentum can roll over, but you're right. We've talked a lot about central banks and the interest rate action, but for now, we've gotten through some major events, major data points on CPI, PPI this morning. It opens up a window for momentum to really continue from that perspective. So yes, I think you stick with the equity market. Growth is still strong, though moderating. Inflation moderating it's all great for valuations, and like I said, you don't fight the tape when momentum is this strong. And
what is momentum? I mean, is that a story of the biggest technology stocks? Is it just playing the broader market? How would you?
I guess I hedge. Of course, the best momentum is in the tech plays in the U.S. and of course the AI theme. Although breadth is somewhat better this year than last year, I would say. So one way to hedge that, and what we're doing in our portfolio, is still maintain broad diversification across sectors, across regions. If we're going to push new highs sustainably, I do think that you're going to see more participation across broader parts of the market, and particularly if it's on a theme where rates are moderating, and that broadly supports, I think, growth and the broader market as well.
So the TSX becomes an interesting story in that conversation, because I think when we made an argument that things were diversifying or spreading beyond just tech earlier this year, people said, aha, look at the Canadian market and all those value areas tied to maybe some cyclical love. And now, so far in June, we've struggled to find that momentum that we previously saw. What do you make of it?
I mean, a lot of it has been the resource sector. Energy's been under pressure. Metals even more so. Still, strong diversifiers, right? So, again, if we're wrong in terms of inflation moderating, we've seen that generally in those inflation scares, you've seen resources and energy hold up quite well. So again, that Canadian allocation within the portfolio can be a strong hedge against some of the things that could go wrong on the inflation front as well.
And in terms of the so you would say that having exposure to big tech or the U.S. markets is a good thing. Having Canada in your portfolio is in some ways a hedge for your overall equity exposure?
That's right. So the broader diversification, again, instead of really piling in and chasing that one theme a little bit too much, which I do think we are seeing in corners of the market, at this point in time, if you participated in that theme, great, take some profits, diversify somewhat more. If you have been diversified, again, keep up with that. I think it's a good long-term strategy.
We have some comments just breaking from a Bank of Canada official this morning saying it's reasonable to expect more rate cuts from our central bank if the inflation story continues to work in favor of what the Bank of Canada is hoping. That's a very similar message to what we got from Tiff Macklem last week. How does the economic story and the rate cut story factor into your math here for investing in the stock market?
Yeah, it's interesting. At this point, Canada, we would say probably, cut and was somewhat dovish, so a little bit more, the Bank of Canada was on the more dovish side of things compared to the ECB cut and was hawkish. The Fed, of course, was on pause and a little bit mixed in their messaging. But generally, this sense of reducing rates before the economy tips into something more severe, quite supportive of stock markets, and that's what you've seen. So again, it really does feed the bull case for stocks. And again, if it's happening in advance of significant economic weakness, keeps that soft landing story alive. It will take some time to see if that Goldilocks scenario can be achieved, but the market will continue to believe in that narrative, which again has been very positive for equities.
I also want to, since you look at everything, I want to talk a little bit about the bond market, where the yield, so just to remind those who aren't all in on fixed income all the time, when there's a changing view on interest rates, if people think interest rates are going to go down, typically you see people actually buying bonds because they want to lock in the yields that are there because they don't think that's going to be there in the future.
Exactly.
And so, we last year started to see yields on some of the key bonds we watch in the U.S. and in Canada going down as people were buying bonds because everyone was saying rates are going to go down,
right.
Rates are going to go down. Then we get into 2024,
right, exactly.
and we have to reset our expectations. But I would say since April, definitely May, the same thing's happening again. Okay, the Bank of Canada cuts rates, maybe the Fed goes, maybe other central banks around the world, and you start to see those people buying bonds and yields are starting to come down.
Right.
So it opens the door to this question, is this a good time to be locking in fixed income?
Absolutely, and this, one of the themes that we're certainly out there talking about, because we know that many, and with high rates on cash instruments, of course, many investors have been holding high levels of cash, certainly much higher than they have over the past many years, right? The question is, how long do you wait as interest rate cuts begin to bring down those cash yields before you put that to work? And we're advocating, you extend that duration, right? You get into that medium-term fixed income, that 5 to 7, 8 year term where you're getting still very good income. Like you said, bond prices, you get the capital appreciation when interest rates fall. And importantly, as our work shows, as inflation begins to drop below the 3% range, you begin to get that really strong diversification effect against all the stocks that you're holding in your portfolio, right? If growth becomes a concern, your bonds begin to rally even more and offset any losses on your equity portfolio.
Anything you'd be avoiding right now, Chad?
It's an interesting question. There's pockets of the market, higher yielding fixed income. Right now is not particularly, and that would be more riskier parts of the fixed income market. The compensation for the risk is not particularly great. At the same time, we do watch. Are we seeing a lot of risk of huge credit events, et cetera? We don't see that as particularly high, but the risk compensation is not really there. So, the story on fixed income, we're primarily talking about investing in higher quality investment grade bonds.
Okay.